Preparing for a finance manager at T-Mobile interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your experience in financial planning and analysis. I have built annual budgets, quarterly forecasts, and monthly performance reporting for operational and corporate teams. My approach combines driver-based modeling with regular conversations with business leaders, so forecasts reflect operational reality rather than just historical trends. In my last role, I improved forecast accuracy by separating volume, price, and productivity drivers and establishing monthly reviews. I also translated results into clear recommendations for leadership, which helped managers act earlier on cost pressures and investment opportunities. While answering, focus on budgeting, forecasting, variance analysis, business partnership, reporting cadence, and measurable outcomes. Connect your experience to operating in a fast-moving, customer-focused telecommunications environment. Question 2. Why do you want to join T-Mobile as a finance manager? T-Mobile appeals to me because it combines a strong challenger mindset with a complex, capital-intensive business. The company competes through customer experience, network quality, value, and operational execution, all of which require finance to be commercially engaged. I want to help leaders understand the economics behind growth, retention, device promotions, and network investment. My background in driver-based planning and cross-functional partnership would let me bring financial discipline without slowing decisions or losing sight of the customer. Make sure to cover T-Mobile's challenger brand, customer-centric strategy, network investment, growth opportunities, and the finance manager's role in converting operational decisions into profitable, disciplined outcomes. Question 3. Which operating metrics would you monitor for T-Mobile's wireless business? I would monitor postpaid and prepaid net additions, churn, ARPU, service revenue, customer lifetime value, upgrade activity, device margin, network costs, EBITDA, and free cash flow. I would not view them independently. For example, aggressive promotions may improve net adds but dilute ARPU or increase acquisition costs. I would segment results by customer type, channel, geography, and tenure, then connect operational metrics to profitability and cash generation. That linkage helps leadership distinguish sustainable growth from expensive volume. In your answer, talk about postpaid and prepaid net adds, churn, ARPU, customer lifetime value, service revenue, device economics, network costs, EBITDA, cash flow, and how metrics interact rather than stand alone. Question 4. How would you build a monthly forecast for T-Mobile's service revenue? I would build the forecast from subscribers rather than applying a simple growth percentage. The model would roll forward beginning customers using gross adds, churn, migrations, and expected upgrades, then apply ARPU by segment and plan. I would separately model promotional credits, seasonality, and unusual events. After loading actual results, I would explain forecast to actual differences by driver, refresh assumptions with commercial leaders, and run sensitivities for churn, ads, and pricing before presenting the outlook. Be sure to mention subscriber cohorts, gross adds, churn, migrations, ARPU, promotional effects, seasonality, management assumptions, actual to forecast reconciliations, and sensitivity analysis around key commercial drivers. Question 5. Tell me about a time you explained an unfavorable variance to senior leadership. In one quarter, operating expenses were 8% above plan. I first separated timing, volume, rate, and one-time items, then found that contractor costs and accelerated technology work explained most of the variance. I prepared a concise bridge, validated the causes with operations, and showed the full-year impact under 2 scenarios. Leadership approved a spending rephasing plan and tighter purchase order controls. By quarter end, the recurring run rate was back within 2% of budget, with no disruption to critical projects. Focus on the situation, analytical process, root cause, concise communication, corrective action, and result. Use a star structure and distinguish timing issues from permanent changes in business performance. Question 6. How would you evaluate a device promotion or customer acquisition offer? I would evaluate the offer on incremental economics, not gross customer additions alone. I would estimate acquisition volume, device subsidy, promotional credits, commissions, expected ARPU, churn by cohort, and servicing costs. Then I would calculate contribution margin, customer lifetime value, and payback under base, upside, and downside cases. I would also test cannibalization and whether existing customers receive the same benefit. A promotion is attractive only when incremental lifetime contribution exceeds acquisition investment at an acceptable risk level. Make sure to cover incremental customers, subsidy or promotional cost, gross adds, churn, ARPU, contribution margin, lifetime value, payback period, cannibalization, and scenario testing across customer segments. Question 7. Describe your approach to building an annual operating budget. I start by translating company priorities into financial drivers and planning assumptions. I combine top-down targets with bottom-up inputs from sales, operations, technology, and corporate functions, then challenge volume, headcount, vendor, and capital assumptions for consistency. I document owners and decision dates, maintain version control, and highlight trade-offs rather than hiding them in averages. Once approved, I create monthly scorecards that compare actual performance with budget and refresh the outlook when material assumptions change. In your answer, discuss strategic alignment, bottom-up operating inputs, top-down targets, driver-based assumptions, challenge sessions, ownership, version control, and post-budget accountability through monthly performance reviews. Question 8. How do you distinguish a useful forecast from a budget? A budget is an approved plan that sets targets, resources, and accountability for a period. A forecast is the best current estimate of what will happen, even when that differs from the budget. I keep the forecast unbiased and update it when real drivers change, while preserving the original budget for performance evaluation. That distinction lets leaders see both execution against commitment and the latest business trajectory, supporting better decisions on hiring, spending, pricing, and investment. While answering, explain that budgets establish targets and resource commitments, whereas forecasts provide the best current estimate. Discuss rolling updates, unbiased assumptions, decision usefulness, and accountability without confusing forecast changes with performance excuses. Question 9. What would you include in a capital expenditure business case for network investment? I would begin with the strategic problem, such as capacity, coverage, customer experience, or regulatory need. The business case would include equipment, construction, spectrum-related costs where relevant, timing, operating expense impacts, incremental revenue, and avoided costs. I would calculate NPV, IRR, payback, and scenario sensitivities for demand and execution delays. I would also identify dependencies and measurable success criteria, then compare the investment with competing uses of capital. Post-approval, I would track benefits against the original case. Be sure to mention strategic need, coverage or capacity benefits, timing, construction and equipment costs, operating savings, incremental revenue, NPV, IRR, payback, risk, dependencies, and post-investment measurement. Question 10. How would you analyze T-Mobile's free cash flow performance? I would reconcile EBITDA to free cash flow through cash taxes, interest, working capital, capital expenditures, and other significant cash items. I would separate recurring performance from timing effects, such as vendor payments, promotional settlements, or tax timing. I would also compare capital intensity with network deployment needs and evaluate whether cash conversion is improving sustainably. Finally, I would bridge actual results to forecast, explain major variances, and assess implications for debt reduction, shareholder returns, and strategic investment. Focus on EBITDA, cash taxes, interest, working capital, capital expenditures, spectrum or other investment items, timing effects, recurring versus non-recurring cash flows, and reconciliation from earnings to cash generation. Question 11. Tell me about a time you improved a financial reporting or forecasting process. My previous reporting process relied on manually consolidated spreadsheets and often took 5 business days. I mapped the workflow, eliminated duplicate schedules, standardized account mappings, and built an automated data refresh with controlled review points. The close package was reduced to 2 days, and managers received consistent variance commentary earlier in the cycle. I also documented ownership and exception controls, so the improvement did not depend on one analyst. The result was faster decision-making and fewer late adjustments. Use a specific example showing the original problem, root cause diagnosis, automation or standardization, stakeholder adoption, control improvements, time saved, and measurable effect on accuracy or decision speed. Question 12. How would you partner with a non-finance leader who challenges your forecast? I would first understand why the leader disagrees and identify which operational assumption differs. Rather than defending a spreadsheet, I would review the drivers together, compare them with historical trends and external evidence, and separate facts from judgment. If uncertainty remains, I would present a range with clear implications instead of forcing false precision. My goal is shared ownership of the forecast. I can challenge assumptions firmly while respecting the leader's expertise and keeping the discussion focused on decisions. In your answer, emphasize curiosity, active listening, transparent assumptions, shared operational drivers, evidence-based challenge, scenario modeling, and preserving the relationship while maintaining financial integrity. Question 13. What is your understanding of ASC 606 revenue recognition in a telecommunications company? ASC 606 requires revenue to follow the transfer of promised goods and services to the customer. In telecommunications, a contract may include a handset, wireless service, equipment installment payments, and promotional credits, so finance must identify performance obligations and allocate consideration using relative standalone selling prices. Revenue timing may differ from billing, creating contract assets or liabilities. I would partner with accounting and commercial teams to validate assumptions, monitor contract changes, and ensure promotions are reflected consistently. Make sure to cover identifying contracts and performance obligations, allocating transaction price, handset and service components, promotional discounts, contract liabilities, estimates, and collaboration between finance, accounting, legal, and commercial teams. Question 14. How would you investigate a sudden increase in customer churn? I would first validate the data and confirm whether the change reflects a definition, timing, or reporting issue. Then I would segment churn by tenure, plan, geography, channel, device, and customer value, comparing each cohort with historical patterns. I would investigate network experience, billing, pricing, promotions, competitor activity, and service interactions. After identifying likely causes, I would quantify retention actions, estimate lifetime value preserved, and recommend targeted interventions rather than broad discounts that could damage margins. Discuss data validation, cohort and segment analysis, competitive activity, pricing, service quality, billing, device lifecycle, geography, retention offers, root cause testing, and translating findings into financially measured actions. Question 15. How do you use scenario analysis in a volatile operating environment? I begin by identifying the few assumptions that could materially change the outcome, such as churn, gross adds, ARPU, device costs, labor, or capital spending. I build base, upside, and downside cases with explicit operational narratives, then test sensitivities and cash implications. I also define trigger points that would prompt management action, such as slowing discretionary spending or revising promotions. This keeps scenario analysis practical. Leaders understand both the range of outcomes and the choices available. Be sure to mention key uncertainties, base, upside, downside cases, sensitivities, trigger points, liquidity or covenant implications, decision thresholds, and keeping scenarios actionable rather than producing excessive model complexity. Question 16. Describe a time you had to deliver difficult financial news. I once had to tell a business leader that a major initiative would miss its savings target by approximately $4 million. I prepared a transparent bridge, confirmed the estimate with the project team, and explained which assumptions had changed. I led with the implication, then offered options: renegotiating vendor scope, delaying lower value work, or accepting the shortfall. The leader appreciated the early warning, selected corrective actions, and we reduced the final gap to about $1.5 million. Focus on factual preparation, empathy, clarity, business implications, options, ownership, and follow-through. Demonstrate that you can communicate unfavorable results without becoming defensive or creating unnecessary alarm. Question 17. How would you prioritize competing requests from senior stakeholders? I would assess each request against strategic importance, customer impact, financial value, risk, urgency, and required resources. I would clarify deadlines and dependencies, quantify trade-offs where possible, and rank requests using consistent criteria rather than seniority alone. If resources remain insufficient, I would present leadership with explicit options and consequences. Once priorities are set, I would communicate them clearly, reset expectations, and revisit the ranking when facts change. That creates transparency and protects the team from constant reprioritization. In your answer, cover strategic alignment, customer and financial impact, urgency, regulatory or operational risk, resource constraints, transparent trade-offs, escalation, and communicating priorities clearly to affected teams. Question 18. What controls would you expect around management reporting and forecast models? I would expect controlled data sources, reconciliations to the general ledger or operational systems, documented assumptions, protected formulas, restricted access, and clear version control. Material changes should have an audit trail and reviewer sign-off, while model outputs should be checked through reasonableness tests and independent calculations. I also separate model ownership from approval where practical. Strong controls should make reporting reliable without making it unusably slow, especially when leaders need timely insight during a changing forecast. Make sure to discuss source data integrity, reconciliations, access controls, formula protection, documented assumptions, review sign-offs, change logs, version control, segregation of duties, and auditability of key estimates. Question 19. Tell me about a time you led a team through a tight deadline. During a compressed quarter end, our team had 3 fewer business days than usual because of a system transition. I divided the work by critical path, assigned clear owners, created daily checkpoints, and moved low-risk analysis after core reporting. I personally reviewed the highest-risk reconciliations and escalated data issues early. We delivered the package on time with no material errors, and I documented the revised process afterward. The experience reinforced that structure and communication outperform last-minute heroics. Use STAR and describe planning, role clarity, workload allocation, quality controls, communication, escalation, coaching, and the measurable result. Show calm leadership rather than relying solely on personal effort. Question 20. How would you demonstrate T-Mobile's customer-focused and ownership-oriented culture in finance? I would treat finance as a decision partner whose work ultimately affects customers. That means understanding how pricing, promotions, network investment, and service processes influence customer value, not just reporting their accounting impact. I would take ownership of issues, communicate early, simplify analysis, and recommend practical actions with measurable outcomes. At the same time, I would protect reporting integrity and challenge decisions that create short-term gains but weaken long-term trust. Speed matters, but responsible execution matters equally. Be sure to connect customer impact, accountability, speed, simplification, ethical judgment, data-driven decisions, cross-functional partnership, and willingness to challenge inefficient processes while protecting financial and reporting quality. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.